and welcome to this TIOmarkets spreads. So what do we mean by spreads? Well, spread in financial markets is just very simply the difference between the market bid and the market offer. So if you were seeing a two-way price, let's just say you were trading stocks, for example, and you were trading Apple stock, and you saw a bid of $210 and an offer of $211, the difference is $1, and that is your spread. So that's what we're referring to in spreads. You will find spreads across all financial markets, all different asset classes, and the reason people ask, well, why the spreads? The reason there are spreads is essentially that's how liquidity providers and market makers make their money. They want customers dealing and crossing spreads, and that's they get given on their bid and they get paid on their offer, and that's how they make their money. So that's why there are spreads. Just to give a little bit of historical perspective, if you turn the clock back, 25 years ago, retail foreign exchange trading was extremely limited. The sort of rates back then, and it wasn't even electronic, it was probably done over the phone, would have been very similar to the sort of rates you get today when you go to the airport and change your money up before getting on the plane. As we all know, those rates are not very competitive, and certainly wouldn't be used for speculative trading. That is very, very different today. And I would say today the rates the average retail trader sees in the FX markets and the commodity markets as well, for that matter, are as good as, if not better, than the sort of rates that the top institutional traders such as banks and hedge funds would see. It is a very competitive space, and we at TIOmarkets take that very seriously. So we want to make sure we can provide our traders with the very best spreads available around the clock. As you may have noticed, spreads are not the same between all brokers, and they certainly do not stay constant around the clock. And there are certainly a number of reasons why that can be. So I just want to touch on very briefly why that can be. The first major reason spreads change is going to be due to time zones. Historically, the most illiquid time zone is probably at the end of the New York day, when New York's done, the US is done, and before Asia has really gotten going, and it's just Australia and New Zealand. That is typically the most illiquid time of day, and the time of day when you will see spreads potentially widen out more than probably at any other time. Need to keep in mind that when the market opens on a Monday morning or a Sunday night, depending where you are in the world, it is opening into that Sydney and Australia time zone. So expect spreads to certainly be wide on the open, and note that it will take a little while for them to tighten up as the major Asian centers become open. Moving into Asia, you would expect those spreads to tighten up, but still be probably wider than we might see during European or US or North American hours. The major currencies tend to remain pretty tight around the clock. Things like euro dollar, dollar yen, Australian dollar, Canadian dollar, etc. They do tend to be fairly tight, but some currencies might widen out. Sterling can certainly widen out. Swiss could widen out during the Asian time zone. So just keep that in mind. Another reason you might see spreads widen out can be due to holidays in certain centers outside of the major global holidays like Christmas Day and New Year's Day, when the retail FX market generally is closed. But outside of that, in the regional holidays, let's say July 4th in the United States, it's a major holiday. Whilst the retail FX market is most likely going to be open and available to you, you would expect spreads to be wider. Same applies in other countries. Japanese holidays, UK holidays, European holidays, etc. Whilst the market is open, you could expect spreads to widen out. The next time when it's probably the time when most retail traders notice spreads widening is just ahead of a major economic data release. So that can be in the form of employment data, inflation data, retail sales, the results of a central bank meeting, for example. These are known economic events. We know some data is going to come out. We know it could potentially move the market. At that point, just prior to that data coming out, you would expect spreads across all currency pairs, as well as potentially indices as well, and commodities possibly. Expect them to widen out, and then once the data has been released, it would be normal for those spreads to start tightening up again. Similarly, there are unknown economic events or political events, for example. The U.S. president, the current U.S. president, we know, loves to release the occasional tweet, and world leaders are always making speeches and can on occasion make comments that affect the markets. Those would not necessarily be scheduled and can cause volatility, and same we would expect to see spreads widen out. Also situations, if you had we've seen a couple of occasions over the years where we've had flash crashes in stock markets that can cause a great deal of volatility across other asset markets. You'd expect spreads to widen out. A period of time like the financial crisis back in 2008, for a long period of time, you would expect spreads to be much wider than you would expect to normally see. And then finally, on the very rare occasion where there's a catastrophic event, something like 9/11, for example, again, you would expect spreads to widen out. And finally, there are some currency pairs that you will see them at times of the day. You're going to see them fairly liquid, and at other times very illiquid. And I'd sort of refer to them as regional currencies in a way that, something, a prime example might be something like the South African rand, Mexican peso, Norwegian kroner, Swedish kroner. These currencies are very actively traded, but they tend to be very actively traded during their own time zone. So like the rand, it kind of mirrors the European time zone in South Africa. You'll see prices fairly tight during that period of the day, but then, as you move into the US time zone and then more specifically into the Asian time zone, you would expect those spreads to widen out considerably. The same with Mexican peso, obviously very actively traded during the US time zone. But again, moving into Asia, much less liquid, and you would expect spreads to be widened. Same with the Scandinavian currencies, very heavily traded during the European time zone, far less so during the US, and much less so during Asia. And the one important thing to note, which just, when you are taking position, especially if you're a trader that likes to trade around the clock, and maybe you're running a specific proprietary position, and you're taking a position and you're just holding it, just bear in mind that those widening of spreads, especially once the US market is closed and you then move into the early Asian market, those spreads can widen out quite considerably. Doesn't mean the market has moved, but to protect themselves, the liquidity providers will widen the spreads out, and there is a danger with the way that MetaTrader operates. You could get liquidated even though the market hasn't moved. So it's advisable to monitor those markets maybe when you are running a position around the clock, just to see what those spreads look like, and to make sure that you have sufficient funds in your account to be able to hold a position, as I said, not because the market's necessarily moved, but just because spreads are blown out. And that spreads. We take it very seriously. We're going to be able to offer you the best spreads in the market to be able to trade on. And we wish you the very best of luck with your trading. Thank you for choosing TIOmarkets.